All right, everybody, here we go. It is Sunday, October 28th, 2018. Welcome to my newest segment of Markets A Look Ahead. As usual, there's a lot to talk about, and I'm going to try to put this together in a way that makes sense. Before we go over to my website and look at some charts, let's put a perspective on what's going on here. It's pretty straightforward, and it's spooking a lot of people because they're just not used to seeing this crazy volatility in the market. What am I talking about? 500 points up, followed by 500 points down, followed by 800 points down, followed by 400 points up. I mean, it'll rattle anybody. It's the truth. But again, if you know where to look, you can see that what we are witnessing is not the big one. This whole market is not about to melt down yet. There is an enormous, and I mean that, I can't overstress that word, effort being made to keep the bond market stable. Let's talk about that for a moment here. What has existed since the meltdown of 2008 is unprecedented. It's never been tried before in the history of the world. It's never been seen before in the history of the world. Well, what am I talking about? A coordinated effort between world central banks to buy everything that they possibly can, massively inflating their balance sheets, creating a bubble in debt like we've never seen before. And, it gets ignored. No one wants to talk about it. It's always look here, don't look here. It's always the same story. You all know that. And I believe sincerely that the powers that be, world leaders, are keenly aware of the dangers that lie ahead here. There's never been a plan to unwind this debt. We can't borrow our way into prosperity. It's just not going to happen. We are going to hit a wall at one particular time. Hopefully it's not at hypersonic speed. I've explained this to you all for so many years now. And it's a very unfortunate situation that we're in, but we're here. So now that we are here, let's deal with it. With that said here, let's think about what happened last week. Again, extreme volatility in the stock market, no secret, but also we watched that 10-year yield here in the United States come down significantly. We've also seen the dollar get stronger, and I've been covering these dynamics for you in video after video after video. It is still my firm belief, and I've never wavered from this ever, that we are going to see the big one begin in the debt market. It's the biggest bubble of them all, and that one bubble is supporting every other bubble and keeping every distortion that exists in this market real, I guess, where it is now. It's not going to last forever. We know that. We also just look back on history. I mean, markets run in cycles. That's another thing that you'll never hear from any of the Confederacy of Dunces out there, that we have risk on, risk off, risk on, risk off. These things just the way it is. You can't know that. You're just not supposed to know. All right, well, at least you know now. So what we are going to do, my lovely friends, is make our way over to my freakishly lovely website. There is a link in the description of this video. Click on it, traderschoice.net. Let's look at some charts together. If you happen to be on my website, well, I'm there now. Let's go over a few things here. Let's go straight down to the bottom of this page. This gauge here that you are now looking at least I hope, technical analysis for SPX, or the S&P 500. This is a weekly gauge. I want you to keep this in mind. This gauge has been scary accurate, but better than 85% of the time this gauge has been right. Let's look a little deeper into this gauge now. You see, we're getting a sell signal here, right? Let's look below where it says sell. We have 11 sell signals, 10 neutrals, and 5 buys. Okay, this does not mean, and I keep getting emails about this, hey Greg, your gauge says sell, should we just dump everything? Absolutely not. No, 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 no. Again, this is one tool. Keep that in mind. It's an accurate one, but this does not mean that we're going to get in here and dump all our stocks or whatever your investments might be if you're in equities. No, 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 no. We have to put other things together, and that's what I try to do for all of you every single lovely day. Now, let's go to the chart right above here, trading chart. SPX is in there. I want you to click on it anywhere. Just click on that chart and scroll in deeply. Bring it all out. You got it? So, what I want us to do here, I want you to look at, let's look at the top segment of this chart here. You see those 3 blue bands? Okay. We're kind of riding along that lower band. That is, in my view, somewhat of a bearish sign, okay? We want to be somewhere above that middle band here, okay? There's those 3 bands. So this is somewhat bearish. However, let's go just underneath that. You see where it says Fisher 9? You see you have those, a blue and a red, kind of looks like almost like a ribbon. If you scroll in here, you'll see we have a crossover. The blue is now crossing over the red. I'm not saying that this is telling us that we're going to rocket higher, but this may be a signal. If you put all this other stuff together, like I've been explaining to you with the bond market, rates coming down, that the market, although I do believe we're going to still have some volatility, is looking for a bottom. You understand? That's what I think is happening. Now, if you look below this at the MACD, see MACD, 1226, close 9, you can see here as well. I think the market is trying to find a bottom here. And I also believe, only because we've been seeing this in the market, every time we get a big sell-off, like for example, on Friday, the Dow Jones Industrial Average was down 550 points at one time. And when it gets real down low like that, you see there's a lot of buying. So there's no panic like running for the door in this market. It's just not happening. You know, while we're on the topic here, you can see all my credit spreads right over here. These are all my newest positions. So you can use this as a gauge as to how I'm structuring my own credit spreads. Let's look at a few more things, my lovely friends. So what we're going to do, importantly, is go right over here to the bond market chart. Let's look at that bond market chart. I mean, look at the buying here that we had. It's epic. Green candlesticks. Now we're kind of flattening out. I sincerely believe you're going to see either this remain stable or more buying to keep the 10-year yield where it is. Now let's look down at that dollar chart. US dollar bullish ETF. No secret, dollar's been getting stronger, stronger here. We need to watch that. Again, there is a compensatory mechanism that exists, and I go over it all the time, between the 10-year yield and the dollar. So what we do not want to see, is a sell-off in the bond market with the dollar getting stronger. That is very stock market negative. You understand? What we do want to see is the dollar not getting stronger or actually getting weaker. Did you see the turnaround in the dollar on Friday? It was incredible. I mean, you can see it in that chart right there. We had dollar up, then all of a sudden, bam, it just reversed. Stocks started to respond in a positive way. That's a big reason why we came off of the lows. You understand? This stuff is not really that hard to understand. All right, so let's go back to the center chart here. I want to look at a couple of other things with you that we always do. Where it says SPX, put in GLD, enter. What do you notice about this chart? Remember I was telling you about the three blue bands? The price action is above the top band here. That is bullish. Bullish. Understand? See? It's not easy. It's not hard. This stuff's very easy. Very simple. Let's put in SLB. Enter. All right. Now, if you notice here, we're not above that top band, but we are above the middle band. This is also bullish. So, with that said, if you want to look at just two dynamics here, look at the dollar chart. Weaker dollar means strong. Higher, well, let me just say this again. Hold on a minute. Erase what I just said. In a real market, a weaker dollar would mean higher prices for precious metals, but not here. But we do understand that a stronger dollar is also negative for the stock market. You got it? So look, I hope all of this makes sense to you, and let's try to put this into some kind of sense. I believe, and I covered this on Friday, we are going to see more of this in the stock market. Gauging from the chart we were looking at with regard to SPX, if you want to put that back in here, and looking at a couple of indicators, it seems to me like the market is trying to find a bottom. I don't think there's a bottomless pit here with regard to the stock market. And why? Because the bond market is being propped up. It's so simple. And when that happens, it opens. The lower the 10-year yield goes in this environment, okay, the wider the doorway opens for cash to roll right into the stock market. And that's been the mechanism since 2008. So you should not be surprised about this. Federal Reserve keeping rates suppressed opens a doorway for cash to move into the stock market and inflate bubbles all over the place. This is a global phenomenon. It's true. Anyway, my lovely friends, we will resume these festivities tomorrow morning. We're going to cover some more stuff. It's going to be just all kinds of exciting. I'll see you then. Have a great Sunday.